Good morning, everybody. Welcome to our Thursday Q&A discussion, where we discuss the research that our analysts do and the digging in the company numbers that they do for us so that we can make informed decisions when we buy and sell shares. Just a reminder about the disclaimer that this is not advice and you should judge your own particular individual situation before buying or selling shares. We all know the risks involved. And today we've got Matt Swart, who's a senior analyst, and Pierre Muller, who's our banking analyst, and we're going to be talking about FirstRand. But before we do that, I want to remind you that we're currently busy with the Stockbroker of the Year survey. That is a survey that we use and where you, our clients, get the opportunity to judge us on certain service elements. And how you perceive our service to be, and that gives us insight into what we can improve and how we can service you better. So I respectfully request that you avail some time for it and complete that survey for us and let us know when you've done it. You stand a chance to win 10,000 Rand in your BDA account with us in a lucky draw for everybody that's completed that. And that survey was going to run until, I think, Monday, but it's been extended to the 8th of August. So we've still got time for you to complete it. So please, I'm going to post or ask Glenn to post the link in the chat. And then you can access it from there. If you would be so kind as to complete that for us, because we really do learn a lot from that. I'm going to hand it over to Pierre now to talk to us about FirstRand and tell us what's happening at the banks. Thanks, Pierre.
Thanks, Sarel. Good morning, everyone. So today we're looking at FirstRand, not necessarily earnings release, but specifically the asset quality and provision coverage. So we've seen a decrease in its provision coverage and its credit loss ratio, sitting at the bottom end of its through the cycle range. And this is quite in contrast to its peers, which have been increasing provisions recently, and their credit loss ratios are sitting at the top or above their ranges. So looking at a macro environment, we still see some credit demand happening, and FirstRand commenting specifically that they use a targeted origination approach, so currently targeting lower to middle risk clients, and they see still some growth. Management also said that they commented that on the type of income clients, so below 400,000, we can see the client base decreasing at a slower pace compared to the above 450,000 income level. So, and also on the credit demand, which matches this, we see that they've increased the advances in their previous results by 10% for clients above the 450,000 income bracket, while the income client group below that bracket actually decreased by 6%. So clearly shifting there to a type of lower risk advances. Otherwise, we see consumer health definitely taking some strain of rising interest rates and inflation, specifically the retail part of South Africa. Then on a valuation front for FirstRand, if you look at the pricing multiples compared to its history, they're at the lower end. We have a buy recommendation on FirstRand, and what would change our mind is if the profitability outlook compared to peers deteriorate, because FirstRand does have a higher profitability if you measure it on a ratio like a return on equity. Management did, however, guide that for the full year that they're about to present, that we expect a return on equity just below 22%. So it doesn't seem yet like that changed our mind. So this is, if we look at these two graphs, this is part of the event that just triggered our, or prompted us to have a further look, but it also contains some support based on our findings. So both these charts show the same thing, and that is the amount of provisions that they have for bad debts compared to the gross loans on their balance sheet. So the graph on the left, we just used financial statements, so we have a longer history that we can use, so we can include the early 2000s. And then the graph on the right is the SAR BA 900, but it's better in the sense of the if you look at, we use the Decembers there, it's the same period, but in the other graph is the financial years where FirstRand has a June, and so it's a bit of a mismatch in timing there. But nonetheless, it does show the same picture overall. So first of all, so what triggered it, you can see the yellow line FirstRand. On the left graph, it actually decreased recently compared to peers. And on the right graph, where the peers are increasing, FirstRand is flat still. But then some support behind this, we can see that it's at high levels compared to history still. So we're actually sitting at levels above global financial crisis, and also slightly just below the COVID levels, but historically quite high levels nonetheless. Yeah, thank you. And then this graph, the dark black line at the top, that's that provision coverage we just looked at. But the bottom line, or the blue line there, that's the expense, so that we see on the income statement compared to the gross loans. So apologies if I'm going too technical here, but I think it's a quite important thing to look at. So the top line is basically how much they provided for at the moment, and that would talk to the previous graph that we just looked at. And the bottom line is the history through the expense that actually came onto the income statement. So here we can see the peak there was in 2008. It peaked with the global financial crisis, and then again with COVID. And then you can see that max, it's about the 2% of gross loans that they expensed. And then historically, we're sitting on an average of about 1%, close to the 1%. But at the moment, the coverage that they have is just above 3%. So what that tells us is there's definitely a buffer built in here where they are able, or where they're already provided for what is to come. So if we see impairments, that would help them so that the blue line doesn't increase as drastically as they've already expensed for it, and have this higher coverage ratio. So it puts them in a good position in this perspective. We can go to the next graph. So the previous was just accounting how they provide or smooth out the expenses going forward. And that means, so going forward, we might have less expenses because they've already provided from. But now we're going to shift to looking at the actual assets and what they've done recently. Does it justify them reducing coverage? And just take it into context also historically. So as we've seen, we're sitting at historically high levels of provision coverage, but how does the book and the quality look compared to this recent event and also to the history? So if you look at the top graph, non-performing loans, yes, we've seen a recent decrease there. That agrees to our the coverage that we've seen recently decreased. And then it's a bit elevated, but not necessarily as high as history goes, let's say, compared to global financial crisis. So it looks still promising in that perspective. And then on the stages, so this is just how they divide up the loans. So your stage 1 being higher quality, and stage 2 and 3 is becoming a bit more risky, especially with your stage 3 is your basically almost your non-performing loans. So we can also see there how the stage 2 and 3 peaked here in December 20 and June 21, and then how the book improved from there. So that also confirms this further. Then if we go to the next slide. So here what we've done is we've broken up the advances into segments. So if we start at the bottom graph, you'll see the credit loss ratios. So that's a type of a risk where you can see it. So you can see your retail, other personal loans, card, and then let's say your Waste Bank, which is your vehicle asset finance. So them being higher risk type of products. So that's the first thing that you can take out of it. And then if you look at the top, how it's the composition of the loan. So you can see actually these higher type of products, the West Bank, although compared to history, it's kind of at a similar level, but recently it decreased. Then the retail other, there's definitely a decreased trend there. And then the personal loans, we've also seen in the top graph, it recently decreased there. So you can see a shift away from the risky loans or advances, and then your lower type of core lending advances, such as your RMB, which is your institutional and corporate. As you can see, the credit loss ratio is very low there, but that recently increased. So they shifted even in a segment view away from the riskier to a bit less risky segments. And so that's the other confirmation that we can see that it seems adequate. And then on a credit loss ratio at the bottom, per segment, you can see how it decreased after the highs of COVID. And then for most segments, they are lower than the pre-COVID levels. This is not the case necessarily for the retail other. And just have a look at Aldermore, which is the UK part of the business. So I think after looking at all of this, we're actually seeing them having quite good management on the risk side of their books, and it does justify them going into a lower provision of coverage. But still, when we say they went now into a lower, it still seems that they quite adequately provided for compared to history. And yeah, and this does stand in contrast to peers, but we do favor it as at the moment they've shifted correctly before the strain took part mostly. If we go to the next slide. So usually we at the end, we just look at the price comparison and the valuation multiples. So you can see the share price outperformed over almost all the periods, then except for over a 5-year period. And then the next slide, you'll see on a valuation multiple as represented by a PE. You'll see where at the bottom of its history there. So we have currently a 90 Rand intrinsic value, which we updated and recently, so sitting with an upside of 28%. And that brings me to the end of my presentation. Thanks.
Thank you very much, Pierre. Thanks very much. I think we'll jump straight to Shaun on the technicals, and then we'll take some questions. Thank you. Shaun? You're muted, mate.
All these buttons you have to push. Okay.
There you go.
Okay. Yeah, as you can see the chart of FirstRand there, it shows the share price is trading far above its moving averages, the 21-day, the 40-day, and the 200-day moving average, and obviously confirms the bullish trend. And you can also see it's trading above its ascending support trend line. So it's all very, very bullish. The share price is trading above its resistance. This was yesterday about 71.66 Rand. And I see this morning it's up another 0.5%. It's trading last I saw 71.92. So, sorry, 99. It's on its way. It looks like it's going to retest or test its long-term resistance. That's at the 79 Rand 51 level. And as we said now, the intrinsic value is at 90 Rand. So it's got still a lot of upside, and hence our buy recommendation. The lower technical indicator there is the MACD. It's trading in overbought territory, and it's also obviously confirming the bullish price action. Other shorter term technical indicators also show it's overbought, and we would expect some profit taking. But saying that, there's an old saying that shares can trade in overbought territory longer than we can stay solvent. So I'll just watch it very, very closely. Should we see any profit taking, the share price should pull back towards these this resistance zone we're seeing now, and possibly pull back towards the moving averages at the 69, 68 level. Okay, thank you.
Thank you very much, Shaun. Yeah, it certainly is a very sharp spike towards the right-hand side of the chart there. It is fairly bullish. If you remember, we did a poll earlier in the year, and FirstRand was one of the banking stocks that we said that we had to have in our portfolios. And most of you agreed who took part in that poll. And it's certainly starting to pay off. From 70 Rand to 90 Rand. I mean, what was that you calculated, Pierre? To the upside is 28% possible upside there. I agree with Shaun that the first test would be around just about 80, where the long-term resistance lies, but even that's more than 10%, and it certainly looks on its way. I will now open the floor for some questions. If you guys want to ask some questions, you're welcome to put up your hand, put on your mic, put on your camera so that we can see you, or ask your question in the chat. I'll monitor the chat and we'll take it from there. Clive says, thanks for the presentation. There are no other questions, so I'll fire away. Or just confirm what Pierre said. So Pierre, what you're telling us is that FirstRand has made more than adequate provision should something catastrophic happen and they have a lot of loans that turns south or bad. So they're in a good position in that way, and they're also repositioning, tightening things a bit and going for less riskier loans, which for a bank is the ideal position to be in, I guess. I mean, we all frequently talk about a bank like Capitec and the growth rates that they've shown. But then in the same conversation, the risk part of it jumps to mind, and then things sort of tone down. But I think in FirstRand's case, it's clear from what Pierre has shown us that this is a solid bank. There's solid provisions, and they're certainly focusing on the right areas. And as Vaughan has remarked in a previous discussion, that they quite heavily focused on commercial loans, specifically around electricity generation and so on, which we know is a big problem at the moment. Let's see, random question. Yes, Martin, fire away. We've got Matt in the house as well to help us. Random question. Looking at the long-term view, specifically with their ESG criteria, and knowing pressure on loans to seemingly undesirable operations, do you perform some form of long-term view with these in place? So, Pierre, did you get that question?
Yes, I got it. So, no, we don't take a specific view on the exact impact of ESG. I don't think banks are necessarily in a place where they're the worst type of ESG companies out there. They do have, or most of them have loans to mines or coal, companies or so that's not that ESG friendly, but they all have targets to slowly reduce that. I know with the Paris Agreement, most people are looking at the first, let's call it the deadline date is 2030, where they agreed to all countries to reduce to, I think, 30% basically their emissions. So there's a kind of a long period to kind of phase these, let's say the E part, the environmental part of the ESG, to phase that out. I don't see the problem necessarily on the governance or the social aspect in the ESG. I think they're quite good companies. And then if you actually think about the what Sarel just mentioned about the loan growth in renewables, and so they're actually kind of pivoting in that way on a good perspective on the ESG side, I would say. But just to get back to the original question, no, we don't forecast the ESG specifically in a value.
But it's a very interesting question, Martin, because it makes me think now, and maybe Pierre has a view on this. Can the banks be re-rated do you think they would be re-rated if they kept on lending to companies who didn't adhere to these new regulations and treaties and stuff?
Possibly.
No.
Well, I think it depends on where we see the world go. It was quite interesting with COVID and you know, just let's say before it and before the high energy prices, you know, everyone was quite also on ESG, and then there was one moment where they saw the energy prices go away, and then everyone forgot for a moment ESG, you know, on the environmental side, and now they kind of heading back to it again. So at the end of the day, you know, people still want to make profits and things, you know, ESG won't be everything. There's still a realistic side to investments.
Capitalism is alive and well, yes.
So just a comment, maybe. Thanks, guys.
Sure,
it is interesting because it's you know, it's that whole long-term view of with a lot of the research going into long-term views of sustainable operations outperforming in the long run those that don't. I know it's all early days, and I know valuations tend to focus on potentially more the short term and so forth, but really looking at the, you know, the end-to-end value chain of some of these operations. Yes, agree, banks are maybe a bit different, but you know, looking at where they and who they interact with, that seems to be coming through in a lot of, I wouldn't say only from the shareholders' perspective or what do you call those guys, activation or activist shareholders, but in general to say how holistically is this company, you know, forming a social good that, you know, makes it then outperform its peers. So very difficult for us investors, I think, to yet also get to. So it's always interesting to ask the experts how you guys are getting your mind around those kind of criteria. So I'm glad it's not just me that's confused. So appreciate the comments. Thank you.
So what I also just want to add on that, I think we try to outperform the market at the end of the day as well. So if you think of, you should just look at what's your market, and then you should think about mines and so being quite heavy in South Africa. So do you think they have a worse ESG view or better than the banks? And how will that change, you know, like as the pressure comes on in the future? And if you say you want to take a view on ESG, then you know, you can think about it that way. And then just more on an interesting point of view, because I also cover the energy side of things, and there is usually a bit more topical. So we saw some, you know, sovereign wealth funds and so being quite ESG active. But then when I go look at the shareholding of the company where they're trying to be active, and I compare it to the likes of BlackRock's shareholding in that company, and then BlackRock is not, they a bit more capitalist side of things. So yeah, so we'll see.
Interesting. Thank you.
Thanks. Very good question. Thanks, Martin. Thanks for partaking. Any further questions, guys? It doesn't look like it. It looks like you've covered it, Pierre. So to summarize then, it's a very bullish share. It's currently moving strongly to the upside. It's just broken through current resistance levels. It's, in our opinion, could touch previous resistance levels around 79, and the intrinsic value that the guys are calculating here, $90, certainly showing some promise. But as I've stated in the beginning, entirely up to you. You have to evaluate your own situation and not just go all in on something like FirstRand, but certainly something that belongs in a good balanced portfolio. What I wanted to touch on in the last minute or so is we spoke about also hosting these sessions maybe on a Thursday night, or at least replaying what was said, and maybe taking one or two questions afterwards on a Thursday night. And you guys indicated that you would be interested in doing it as long as it's online. And I wanted to run a quick poll to just see how you guys feel time-wise as to what time would best be suited for those sessions at night. I think we'll only be able to start doing it sort of from the end of August. But I'm going to launch a poll now that says add evening Q&A meeting, duplicate, from end of August at this time. And then I've given you three options, 6, 7, or 8 o'clock. I don't know whether we first need to get the kids in bed, those of us that have young kids, or whether we should start at 6 o'clock, which is more or less the time that you get home and you've got a glass of wine in your hand. Let's see what you guys say. I'm going to launch the poll. If you just answer that for me, that'll help me to determine what time we should schedule those and what time would suit best. Let's see, the votes are coming. Oh my goodness, it's a dead tie. We need some more votes, guys. Yeah, there. Okay, well done. It looks like 1800 is the favorite. So we'll certainly do it at that time. So you can be on the lookout for an invite, and then we'll try it at 6 o'clock at night and see how many people attend and what sort of responses we get. There's something else I quickly wanted to ask you. I've added another poll here because we've spoken about derivatives in the last couple of weeks, and we said we wanted to host a derivatives workshop where we could just ask questions about derivatives and maybe spend more time than just the last 10 minutes of this call talking about it, maybe spend 2 hours on it, and also host that at night. And I'm thinking of doing it on Thursday, the 17th of August, which is about 3 weeks from now. I wanted to get an indication from the audience who would be interested in attending something like that for 2 hours, say 6 o'clock on a Thursday evening till 8 o'clock, and we'll take all your questions on derivatives and we'll do a short presentation on that as well. So if you just answer this for me, then that'll also help me to see whether I'm on the right path to helping you guys make better decisions. Let's see. Oh, great, 9 responses so far and 14 responses, and about 80% said that you would attend. That's great. I think so we can assume that it's going to take place on the 17th of August then. Shaun and I will prepare on our side, and you can look out for the invite, and then I'll highlight that in the meetings to come. One last thing, I'm going to ask Lynn to repost the survey link in the chat, so please complete that Stockbroker of the Year survey for us so that we get some learnings from those insights as well. And then thank you very much for attending. Thank you for partaking today. Thank you, Pierre, for informing us, and I wish you all a great Thursday. Have a nice day. Cheers.